Hello everyone, welcome back to another lesson of finance and investment management. In the last video, we talked about some of the easier examples of discounting and non-discounting investment appraisal methods. We also learned the definitions for the investment appraisal methods such as payback, average rate of return or ARR, net present value or NPV, and the internal rate of return or the ARR. In this video, we are going through a more sophisticated calculations for the discounted investment appraisal method, especially for the net present value or the NPV. Okay, so let's jump into it. Assuming that you are going to buy a new machine and you are planning to rent the new machine out for 3 years. In this case, you paid £300 to an agent to evaluate the new machine. The agent did his research and then come back and tell you that a similar machine is generating this following cash flow for the 3 years. However, this cash flow is excluding the inflation rate. The agent anticipated that the inflation rate is going to be 11%, so in other words, both the income and the expenses will be growing by 11% every year. Once you decided to invest in this machine, then this machine will cost you £500,000 and you have to pay at the start of the first year, which means today. Assuming that this machine will go out of date in 3 years, therefore meaning after 3 years this machine will have zero scrap value, or in other words, it would not worth anything. For the government, if we are generating any profit, then we are anticipated to pay 35% tax, and it will be paid 1 year after. The government also allows some capital allowance, which is equivalent to 20% of the cost of the machine at the reducing balance method. To make sure that the whole business operations operates smoothly, we will require to have a 20% working capital. So this 20% is going to be 20% of the sales revenue anticipated to have this amount of cash at the start of each year. Assuming the after-tax annual cost of capital is 10%, then what is the NPV of this project and whether this project is a good or a bad project. Okay, so let's have a look at all of the numbers one by one. First of all, we pay £300 to the agent to evaluate the new machine. Now, this £300 is not going to include in the calculation of the NPV. The main reason is that regardless whether you want to invest in this project or not, you already paid £300 to this agent. Even though you are not going to invest in this machine, you cannot ask this £300 back from the agent because he did his job already, or he already evaluated the machine and he already give you all the information. There is no way that you can ask that £300 back. So this is what we call as the sunk cost, and then the sunk cost will be irrelevant in the calculation of the NPV. For the second set of information, we are looking at the new machine which we are planning to rent out for 3 years. And during these 3 years, we can get 200,000 for year 1, year 2, and year 3. And then the marketing expenses, maintenance expenses, and upgrading expenses that we have to pay for each year. In addition, every year there will be an inflation rate of 11%. So for this question, I'm planning to use the Excel to demonstrate the answer so that everyone can see the formula more clearly. As we mentioned a while ago, this £300 to agents is a sunk cost. Since we cannot get it back, it will be irrelevant for the NPV calculation. Therefore, in this case, the relevant information to us will be the cash flow if we buy the machine. And the first relevant numbers that we have is the income for the 3 years, which is 200,000, and all the marketing, maintenance, and upgrading expenses for these 3 years. Based on the information that we gather from agents, there will be an inflation of 11% every year for the income and for the expenses. First thing that we need to do is to write down the numbers for the income and the numbers for the expenses. So if you can see, if you scroll down, and then you will see here. So in the year 1, we'll receive an income of 200,000. And then year 2, an income of 200,000. In year 3, an income of 200,000. For the marketing expenses of year 1 is going to be 8,500. Marketing expenses for year 2 is 6,800. And marketing expenses for year 3 is 5,700. For the maintenance expenses in the year 1 is 1,500. Maintenance expenses for the year 2 is 4,500. And the year 3 is 9,900. And for the upgrading expenses of year 1 is 3,200. And then it is going to increase to 3,300 in year 2 and increase to 3,400 in year 3. After writing down the numbers for the income and for the expenses, then next we have to calculate for the inflation. In this case, the income for the first year after calculating the inflation is that this 200,000, and we have to multiply this by 1 plus the inflation rate. And in this case, the inflation rate is this 11% over here, which is in the cell A113. And then because this one is the first year, so we raise to the first power, meaning we have to multiply this 11% once. And then this will give us an answer of 222,000 for the income after calculating the inflation rate. For the second year, it is going to be this 200,000, and then however we have to multiply this by 1 times this 11%, which is from the cell A113. And then in this case, because it's the second year, we have to raise to the second power, which is in the cell H135. Which means that this 200,000, we have to multiply this by 1 plus 11% for the first year, and then multiply by another 1 plus 11% for the inflation rate in the second year. Then this will give us an answer of 246.42 thousand. For the third year, we are going to do a similar pattern, which is this 200,000. We are going to multiply this by 1 plus the 11% inflation rate from the cell A113, and we are going to raise this to the third power in the cell J135. The main reason why we are raising this to the third power, because in the first year, this 200,000 have to multiply by 1 plus 11%, and then second year multiply by another 1 plus 11%, and in the third year we multiply this by another 1 plus 11%. Therefore, by raising this to the third power, we will get an answer of 273.526.2 thousand. Not only the income will grow by the inflation rate, the marketing expenses, maintenance expenses, and the upgrading expenses will also grow by the inflation rate. So in this case, for the first year, the marketing expenses of 8.5 thousand is going to grow by this 8.5 thousand times 1 plus the 11% inflation rate in the cell A113 raised to the first power because it's just first year. And this should give us an answer of 9.435 thousand. And in the second year, it's going to be this 6,800 multiplied by 1 plus 11% inflation rate in cell A113 raised to the second power in the cell H135. Then this should give us an answer of 8.3782 thousand. In the third year, it's going to be similar pattern. We are going to get the marketing expenses in the third year, which is 5.7 thousand, and we are going to multiply this by 1 plus the 11% inflation rate, and then we are going to raise this to third power in which is the number in the cell J135. And then again, this means that 5.7 thousand will have to multiply by 1 plus 11% for the first year, and then multiply by another 1 plus 11% in the second year, and multiply by another 1 plus 11% in the third year. So this is the third power. And then the answer we'll get is the 7.7955 thousand. We are going to do the similar calculation for the maintenance expenses, which is in the first year, this 1.5 thousand, we have to multiply this by 1 plus 11% and raise to the first power because it's the first year. Then this will give us an answer of 1.665 thousand. And for the second year, the maintenance expenses will be this 4.5 thousand, and we have to multiply this by 1 plus 11% inflation rate and raise to the second power because it's the second year. Then this will give us 5.5445 thousand. And in the third year, we have maintenance expenses of 9.9 thousand. We have to multiply this by 1 plus the 11% inflation rate, and then we have to raise this to the third power because it's 3 years. Therefore, we will get 13.53955 thousand. We are also going to do the same for the upgrading expenses. So in this case, for the first year, after accounting for the inflation rate, the upgrading expenses for the first year will be this 3.2 thousand times 1 plus the 11% inflation rate raised to the first power because this is the first year, and it will give us an answer of 3.552 thousand. And for the second year, it will be the upgrading expenses of 3.3 thousand, and then multiply this by 1 plus the 11% inflation rate and raise to the second power because it's the second year, and this will give us an answer of 4.06593 thousand. And for the third year, it will be the upgrading expenses of 3.4 thousand. Multiply this by 1 plus the 11% inflation rate, and then raise to the third power because it's the third year, and this should give us an answer of 4.64995 thousand. Next, we want to calculate for the profit. Now, there are two ways that I would like to show you how to calculate the profit. And for the numbers here, they are both the same. There are two different ways, and they are both accounted for or adjusted for the inflation rate already. Now the first way is that we subtract the income of 200,000 minus all the expenses, which is this marketing expenses of 8,500, maintenance expenses of 1,500, and the upgrading expenses of 3,200. The next thing we have to adjust for the inflation rate, which is this. So therefore, we have to multiply this by 1 plus the 11%, and then again raise to the first power because this is the first year. Then this should give us an answer of 207.348 thousand. Another thing that we can do to get the answer is that we can after calculating the income and the expenses with adjusting the inflation rate, then we can just take the sum, which is this 222,000 from the inflation adjusted income minus this 9.435 thousand, that is inflation adjusted marketing expenses for the first year, and then minus this 1.665 thousand from the inflation adjusted maintenance expenses in the first year, and then minus this 3.552 thousand, which is the inflation adjusted upgrading expenses in the first year. And if we put this in the calculator, then it will give us a same answer of 207,300.348. Similarly, for the second year, for the inflation adjusted profit for the second year, we can take this 200,000 minus the marketing expenses of 6,800 minus the maintenance expenses of 4,500 minus the upgrading expenses of 3,300, and then everything we multiply by 1 plus the 11% inflation rate, and then raise to the second year, raise to the second power because it's the second year, and this should give us an answer of 228.431 thousand. Another thing that we can do is that take the numbers that we get from the inflation adjusted income expenses and simply the income minus the expenses. So for the income adjusted inflation adjusted income of 246.42 thousand minus this marketing expenses of 8.378 thousand minus the inflation adjusted maintenance expenses in the second year of 5.5445 thousand, and then minus the inflation adjusted upgrading expenses in the second year, which is 4.06593 thousand, and then put this in the calculator. This should give us a same answer of 228.4334 thousand. For the profit in the third year, the numbers can be obtained by the income of third year, which is 200,000, minus the marketing expenses in third year, which is 5.7 thousand, minus the maintenance expenses in third year, which is 9.9 thousand, minus the upgrading expenses in the third year, which is 3.4 thousand. And then we have to multiply this by 1 plus the 11% inflation rate, and then raise to 3 because this is the third year. And then if we pop that in the calculator, we should get an answer of 247.54121 thousand. Or similarly, another way that we can do this is taking all the inflation adjusted numbers that we calculated a while ago and then simply subtracting the income by all of these expenses. So in this case, it will be inflation adjusted income in the third year of 273.5262 thousand, and then minus the 7.7955 thousand for the marketing expenses in the third year, minus the maintenance expenses of 13.53955 thousand, and then minus the inflation adjusted upgrading expenses of 4.64995 thousand for the third year. And then we pop this in the calculator. This will give us a same answer of 247.54121 thousand. After calculating the profit, the next step we have to calculate for the tax. So from the information we know that the tax rate is going to be 35%, and we have to pay the tax 1 year in arrear, which means 1 year later. In this case, for the profit that we earn on the first year, which is this 207,000, then we have to pay a tax of 35%. However, this amount of tax we are not going to pay immediately, which is in the year 1. It is actually required to pay in the year 2. So if you can see here, in the year 2, we are paying 35% of tax, which is in the cell A120 here, and then it will be have to multiply by the profit in the first year, which is this 207.348 thousand. In this case, the profit that we have to pay, the tax that we have to pay is 72.57718 thousand. Similarly, for the year 2, we get a profit of 228.43134 thousand. For the tax that we have to pay, it is going to be the 35% of this 228.43134 thousand. In this case, the tax will be around 79.95097 thousand. And then the tax amount for the third year is going to be 35% of the profit in the third year, which is this 247.54121 multiplied by 35% tax, and then the tax amount in the third year it will be 86.63942 thousand. And this amount, since we are going to pay 1 year later, it means that we are paying this amount of tax in the year 4. In reality, even though the tax rate is 35%, we might not need to pay this 35% tax in full. The main reason is because sometimes the government gives some kind of allowance or tax benefits to encourage people to invest more or create more job vacancies. In this question, we have a capital allowance that is equivalent to 20% of the cost of the machine at the reducing balance method. There are two ways to calculate the capital allowance. So the first one is that since the capital allowance is 20% of the cost of the machine, which is this 500,000, and the tax is taking 35%, then the capital allowance for the first year will be 35% times this 20% times this 500,000. If we multiply these three numbers, then this will give us an answer of 35,000 for the capital allowance benefit in the first year. And then similarly, since tax is paid 1 year later, we can only claim the capital allowance benefit also 1 year later. Now for the capital allowance in the second year, there will be a small, slightly different calculation. The calculation is that we will take the number from the first year, which is this 35,000, and then since it's a reducing cost method, then we have to multiply this by 1 minus the 20%. Therefore, in this case, we will get an answer of 28,000. For the capital allowance benefit in the third year, since we are selling the machine already and there will be no scrap value, then the amount is going to be this 500,000 for the cost of the machine multiplied by this 35% tax. This is going to be the whole capital allowance that we can get. However, we have to deduct the previous capital allowance that we get already, which is this 35,000 and this 28,000. So we will have, in the third year, we'll get 112,000 left for our capital allowance. After calculating the tax and the capital allowance, then we are able to calculate the after-tax profit. So the after-tax profit for the first year is simply the profit minus the tax and then plus the capital allowance benefit. And since here in the first year, because we will pay the tax 1 year later, and also we'll get the capital allowance 1 year later, then simply the tax will be 0 in the first year, and then the capital allowance will also be 0 in the first year. Therefore, the after-tax profit in the first year is going to be 207.348 thousand. And after-tax profit in the second year is this profit of 228.43,134 thousand minus the tax of this 72.5718 thousand. However, we can get some capital allowance benefit of 35,000. So if the profit minus the tax plus the capital allowance, this should give us an answer of 190.85954 thousand. And for the third year, we'll be getting a profit of 247.54121 thousand. We have to deduct it by the tax of 79.95097 thousand, and we can get a capital allowance benefit of 28,000. And if we put these three numbers together, then we'll get an answer of after-tax profit amount to 195.59024 thousand. And for the fourth year, since we already sold the machine and we are not operating anymore, we do not have any profit. However, because the tax is paid 1 year later, if you remember, then we have to pay the tax of 35% for the profit that is generated 1 year in the third year. And then similarly, we can also claim a capital allowance benefit at the same time when we pay the tax. So in this case, we have to pay a tax of 86.69342 thousand. However, we are getting a capital allowance which is bigger, and then the total amount is 112,000. In this case, we still have a tax benefit of a total 25.36058,000. Capital allowance is that the 500,000, since we are using 20% reducing balance method, then this 500,000 will be multiplying by this 20%, and that will give us a capital allowance of 100,000. And the benefit that we can claim is the is the percentage of this capital allowance that we are paying the tax. And since we are paying a tax rate of 35%, then we can only get 35% of this capital allowance. 5% of 100,000 will give us a capital allowance benefit of 35,000. For the second year capital allowance, it is going to be 20% reducing balance method. In this case, we are going to take the previous year 100,000 capital allowance, and we are going to reduce it by 20% using reducing balance method. So in this case, it's going to be 100,000 multiplied by 1 minus this 20%, and then this will give us an answer of 80% for the capital allowance in the second year. And again, remember, we can pay our tax 1 year later, therefore we are also claiming our capital allowance and capital allowance benefit 1 year later. So second year we will claim it on the year 3. And same, because we are paying 35% tax, therefore we can only claim 35% of the capital allowance as a capital allowance benefit. In this case, we will get a 28,000 for the capital allowance benefit for the year 2, but we can only get it in the year 3. For the third year, since we are going to sell the machine already, and in the question we assume that this machine will go out of date in the year 3, and there will be no scrap value after year 3. So in this case, if you still remember, the cost of the machine is 500,000. However, we have to subtract it by the previous capital allowance that we already claimed, and they are the 100,000 from the first year, which is 20% of the 500,000, and then this 80,000 from the second year, which is a 20% reducing balance method. Therefore, we have a 320,000 left for the capital allowance. And once again, since we are paying 35% tax, therefore we are also claiming 35% of this capital allowance. In this case, we will get a capital allowance benefit of 112,000. So this one is the capital allowance that we can get from the third year. However, since we are paying tax 1 year later, therefore we are also getting the benefit 1 year later. That is the reason why these numbers here are in the year 4. So no matter whether you are doing the 1 steps or 2 steps method for the capital allowance, you will both get the same number, as you can see. And then therefore it will also lead to the same number or same answer for the after-tax profit. After we calculate the after-tax profit, the next thing that we need to calculate is the working capital changes. Easier way to understand what is the working capital. Working capital is the amount of cash that you have to invest to support the day-to-day operation. Now, according to the question, the working capital investment in the start of each year is equivalent to 20% of the sales revenue. A more advanced way to calculate the working capital changes is that we take the difference between the sales revenue in these 2 years and then we multiply this by that 20% working capital requirement. So in this case, since year 0 we do not have any sales, and then in the year 1 we have a 222,000 amount of sales, then we take the difference and multiply by 20%. Therefore in the year 0 we got a working capital of 44.4 thousand. We'll list this 44.4 thousand at here first. I'm going to explain a little bit about this working capital later. For now, let's go to the working capital in the year 1 first. For the working capital changes between the year 1 and the year 2, since there is an increase in sales in year 2, therefore in this case we need to prepare for more working capital or more cash as an example in the preparation of increase in sales. And in this case it is going to be the working capital of year 1, which is this 222,000, minus the working capital of year 2, which is this 246.42 thousand, and multiply this by the 20%, which is in the cell A126 from the question. And if we apply this equation, then this will give us a working capital of 4.884 thousand. Now very important is that you don't have to remember to put the negative sign because this represents a cash outflow. For the working capital changes between year 2 and year 3, once again, because there is increase in sales in year 3, that means we have to prepare more working capital or prepare more cash as an example in the preparation of increasing sales. And in this case, the working capital changes can be obtained by the sales in the year 1, which is this 246.42 thousand, minus the sales in year 2, minus this sales in year 3, which is this 273.5262 thousand, and then this will have to multiply by the 20% based on the question in the cell A126. And if we do that, this will give us a working capital changes of negative 4.42124 thousand. Once again, this is a negative figure because we have to prepare more cash. It is a cash outflow as there is an increase in sales. For the working capital changes between year 3 and year 4, now this is quite important because during the year 4, we are not renting the machine anymore. And in this case, there's no sales in year 4. And if we want to calculate the working capital with no sales in year 4, then what we do is similarly following the similar step, we take the sales figure from the year 3, which is this 273.5262 thousand. We subtract it by the sales figure of year 4, which is 0, and then we multiply this by 20% based on the information we get from the cell A126. Then this will give us a positive figure of 54.70524 thousand. Now this is the positive figure because we are not preparing any money for the year 4's sales, and then after we selling all of the inventory, we can get our working capital back. That's why this is a positive figure. And then the next step is to calculate the cash flow. Now the cash flow can be obtained by adding the after-tax profit with the working capital changes. Therefore, in the year 1, what we will get for the cash flow is this 207.348 thousand minus this 4.884 thousand for the working capital changes. Then this will give us a cash flow of 202.464 thousand for the cash flow in year 1. Similarly, for the cash flow in the year 2 is that we take the after-tax profit of 190.85954 thousand and we plus the negative figure from the working capital changes of 5.42124 thousand. Then this will give us an cash flow of 185.4383 thousand for the cash flow in the year 2. We follow the similar steps for the cash flow in the year 3, which is this after tax profit of 195.59024 thousand, and then we plus the positive figure from the working capital changes of 54.70524 thousand, which will give us a cash flow of 250.29548 thousand. For the cash flow in year 4, even though we do not have any number for the working capital changes since we already ended our operation in year 4, however, we still have some money from the after-tax profit. This is because of the previous calculation from the taxes and also from the capital allowance benefit. And in this case, all we have to do is just to bring down this this after-tax profit to cash flow. So the cash flow for that year will be after-tax profit of 25.36058 thousand plus 0, which give us a positive figure for the cash flow in the year 4 of 25.36058 thousand. Remember that the NPV is a discounting investment appraisal method, which means that it takes into the consideration that the money in the future will worth less than the money today. And in this case, we have to consider the cost of the capital. Now, according to the question, the cost of the capital after tax is going to be 10%. So in this case, if we want to calculate the cost of capital for the year 1, then we take 1 divided by open parenthesis 1 plus the 10%, which is the information that we get from the cell 129, this one here, and this will give us a discount factor of 0.9091. What this equation is trying to tell, this 1 represents 100%. So that means the money that we have today in the year 0, that money will not worth any less. So it's going to worth 100% of the money. However, the money 1 year later is going to worth 10% less. That's why it's taking this 100% from today and it's discounting it by 10%. That's why we get, instead of getting 100%, next year the money will worth 90.91%. And similarly, the money in the year 2 is going to worth even less than the money in the year 1. And again, the discount factor, which is the cost of capital, is at 10%. So in this case, we are going to take the discount factor that we have from the year 1, which is this 0.9091, or if you want to read in the percentage, is this 90.91%, and we want to divide this once again by 1 plus the 10% that we get from the information in A129, which is this one here. And if we do that, we will get a discount factor of 0.8264, or which is equivalent to 82.64%. Applying the similar logic, the money in the year 3 is going to worth even less than the money in the year 2, and in this case we are going to take the discount factor for the money in the year 2, which is this 0.8264, and then we are going to divide this by 1 plus the 10% from the information we get from the cell A129, and then put that in the equation. This will give us an answer of 0.7513, or which is equivalent to 75.13%. And for the year 4, the discount factor for the year 4 is going to be even smaller than the year 3 by 10%. And if we apply this formula, which taking the discount factor of 0.7513 and divide this by 1 plus the 10%, this will give us a discount factor of 0.6830, which is equivalent to 68.3%. After calculating all of the discount factor we get from the cost of capital, which is 10% in this question, next step we have to calculate the present value for each year. Now, to calculate the present value, basically what we do is that we take the cash flow and we multiply this by the discount factor. Now, in this case, we will skip the year 0 for a while. I'm going to explain this later. We start with year 1 first. So for the year 1, we take the cash flow of 202.464 thousand, and we multiply this by the discount factor of 0.9091, and this will give us a present value for the year 1, which is equivalent to 184.05818 thousand. Now notice that this number here, this present value here, is smaller than the cash flow, which means this cash flow is the amount of the cash that we will receive in year 1. However, because the money in the year 1 will worth less than the money today, that's why, and the amount that is smaller by 10% for the cost of capital. That's why after applying the discount factor, we get a present value of 184.05818. That means the approximately 200,000 in year 1 will only worth approximately 184,000 today. Year 2 is that we will take the cash flow in the year 2, which is this 185.438 thousand, and we are going to multiply this by the discount factor of 0.8264, which will give us a present value of 153.25479 for the year 2. And for the year 3, what we'll do is similarly, we take the cash flow of the year 3, which is this 250.295 thousand, and we are going to multiply this by the discount factor of 0.7513. Then this should give us a present value of 188.051 for the year 3. For the present value of year 4 is that we take the cash flow in the year 4, which is this 25.36 0.058,000, we multiply this by the discount factor of 0.6830, then this will give us a present value of 17.32161,000 for the present value in year 4. Okay, now, so we calculated the present value for the year 1, year 2, year 3, and year 4. So how about the present value in year 0 or today? How do we get the present value of today? So the present value for the year 0 or the present value today can be obtained by summing up all of the present value in the year 1 to year 4. So if you can see this one, this add up all of the present values from year 1 to year 4, which will give us a total of 542.68529,000. Then we have to subtract this by our initial investment, which means that if we are going to invest in this machine, then today we have to pay this 500,000, which is in the question that we can get from the information here. And then the next one is that we have to subtract in the changes of the working capital. So in this case, if you still remember what we did a while ago, is that our sales in the year 1, there are 222,000. And the requirement is that we need to have 20% working capital in the start of the year, which means today we have to prepare 20% of this 222,000. And this will give us a working capital of 44.4 thousand. Now again, because this is the cash or the working capital that we have to prepare and we have to pay, therefore is a negative figure because it's going to represent a cash outflow. And the net present value will be summing up all of the future present value from the year 1 to year 4, and then we have to subtract this by the initial investment of 500,000, and also we have to subtract this by the working capital that we have to prepare for this 44.4 thousand. Therefore we get a net present value of negative 1.71471 thousand. Now since this net present value is a negative figure, therefore we will say that if by investing in this project, it will actually create more loss for the investor, and therefore we are going to reject this project. By the way, for the students who prefer to have a safetier calculation for the working capital changes, what you can do is that instead of using the advanced method, which is straight away calculating for the working capital changes, you can do it in the two-step process. So what you will do is that you take the 20% of the sales. So let me show you here. You take the 20% of the sales and then you put it in the first step. So for the year 0, it's going to be 20% of the sales in the year 1. And then this one again, you take 20% of the sales. So 20% of the sales in year 2. And then following the similar step, 20% sales in year 3 and 20% sales in year 4. And then next step, you want to calculate the working capital changes, and then you can be obtained by subtracting the current working capital by the previous working capital. So in the year 0, this is the working capital that we have to prepare today. And since last year we haven't invested any project, that means the difference is a negative for 44.4 thousand. And now for the year 1, the difference is that there is an increase in the working capital of the year 1 because there is an increase in sales. So the working capital changes is going to be the working capital in year 1 minus the working capital in the year 0, then we will get a working capital changes of negative 4.884 thousand. Similarly, for the working capital changes in the year 2, it can be obtained by using the working capital of year 1, which is this 49.284 thousand, and we subtract this by the working capital of year 2, which is this 54.70524 thousand. And because there is an increase in sales, there's an increase in working capital. Therefore, we have a negative working capital of 5.42124 thousand. And lastly, the working capital changes for year 3. Since year 3, we are taking the working capital of year 4, and year 4 we are not selling anything. Therefore, we don't need to prepare any money for the year 3. Therefore, in this case, it's going to be 0, and the working capital changes is that all of the money we invested in the working capital in year 2, we are able to get it back once we stop the operation. And in this case, it's going to be the difference between the working capital in year 2, which is this 54.70524 thousand, minus the working capital in year 3, which is 0, which will give us a positive cash inflow. That's why it's a positive figure of 54.70524 thousand. So once again, if you double check the number, you will actually get the exact same number, which is this 44.4 thousand, and the other capital changes, which is this 4.884, 5.421, and this 54.705 thousand. So either way, whether you want to do it in a more advanced way, which is straight away, or do it in a safer way, which is 2 steps, they will both give you the same NPV. I hope this video is able to help the students to strengthen their knowledge about how to use the NPV calculation. And also, I have posted an additional practice exercise in the spreadsheet for students to do other examples of NPV calculation in the Study Smart. I know this is quite a challenging calculation, so don't forget, if you have any question, drop me a comment in the comment section below. Now, I would like to thank everyone for watching this video, and I will see you in the next one.